Good afternoon, everyone. My name is Kelly Crook, and I'm a COAERS trustee and chair of our legislative committee. I'm pleased to welcome all of you to our COAERS Forum on Long-Term Financial Sustainability and the 88th Session Legislative Proposal. Over the past few years, your COAERS board has been proactively reviewing the long-term financial health and sustainability of your retirement system. The board engaged in a comprehensive assessment to address potential challenges. And for the past 2 years, a joint City of Austin and COAERS working group have been engaged in productive, meaningful, and collaborative efforts to develop solutions to improve our system's long-term financial health and sustainability. Is that better? Okay, sorry, want to make sure y'all can hear me. As a result of this work, COAERS and the city have crafted a proposal to bring to the 88th Texas Legislative Session in January 2023 that touches on several policy areas, including funding, benefits and contributions, and governance. Following comprehensive discussions between City of Austin representatives and COAERS, the Board of Trustees and the city moved to approve an agreed-upon legislative framework for the 88th session to enhance the system's long-term funding and health this past June. Today's forum is an opportunity for all COAERS members to learn about the proposed legislation for the system's long-term sustainability. After the presentation, we will move into the Q&A portion of the program to answer any questions that you, our COAERS members, might have. And now to lead our presentation, COAERS Executive Director, Christopher Hansen.
Thank you, Dr. Crook. Apologies, folks. We are using the microphone so that our participants online can hear the presentation. So apologies for the slight outage of batteries in one of our microphones. My name is Christopher Hansen. I am the Executive Director at the City of Austin Employees Retirement System. And what I'm going to do is walk you through a presentation that I put together. And in this presentation, I'm going to first talk a little bit about the current funded status of the retirement system and some key risks that were identified in our most recent actuarial report. I'm then going to talk about the Pension Review Board and its funding guidelines, as well as a statutory requirement called the Funding Soundness Restoration Plan. This is intended to give you some background on where we're at and some of the challenges we're facing and why there is a need for legislation. Then I'm going to go specifically into the legislative proposal. After that, I have a comparative actuarial analysis that we've just recently run in partnership with our investment consultant and our actuary that shows an analysis of the proposed and existing policies. And I hope that visual representation is very helpful for you to understand meaningfully how this impacts the long-term health of COAERS. And then I'll have some concluding remarks, after which I'm going to turn it over to Mr. Ed Van Eno, the Chief Financial Officer of the City of Austin, for his comments, and then we'll open it up to Q&A from the audience. And then we'll conclude by any comments that any of our trustees would like to make. So first, I just want to give a little bit of background on the funding situation for COAERS. This is based on our most recent actuarial report, our actuarial valuation as of December 31st, 2021. And in that report, the actuary has our funded ratio at 66%. That's the actuarial value of assets divided by the actuarial value of the liabilities. The amortization period is currently at 33 years. And this is a very important metric that I'm going to reference later on in my presentation. The unfunded actuarial accrued liability, also known as the UAAL, was $1.7 billion. Also in that valuation, it's of note that the board approved a reduction in the assumed rate of return, also referred to as the discount rate, from 7% to 6.75%. And that added about $140 million in increased liabilities for the system. The system has benefited from strong investment performance over the last couple of years, and more specifically, the city's increase in its contribution rate from 18% to 19%. That was the most significant positive factor in the system having a 33-year amortization period. And because of our strong investment performance over the last few years, we have about $220 million in deferred investment gains. On the next slide, I'm just going to show you a chart. This is the unfunded actuarial accrued liability visually. And what you can see here is it's at $1.7 billion as of the most recent valuation, and it's expected to continue to grow into the 2030s. And then it starts to decline and eventually gets down to zero when the plan achieves full funding in 33 years. The next slide is a chart of our projected funded ratio, currently at 66%. And as you can see, it kind of slowly increases over into the 2030s and then begins to accelerate towards 100%, which again is projected to be in 33 years. Now, on the next slide, I want to hit a couple key risks that the system's actuary identified because they're very meaningful for what's going on in this discussion and this year. Capital market expectations and the ability of the system to meet its long-term rate of return remain the greatest risk to COAERS' long sustainability. Without additional gains, the unfunded actuarial accrued liability is expected to grow until the 2030s, meaning a large market drawdown soon could materially impact the long-term trajectory of the system. And as we all know, we're going through one of those market drawdowns this year. And I'm going to bring this all back into my presentation here towards the end. But I wanted to tee that up for everybody because that was identified at the beginning of the year as our greatest risk. Now, I do want to spend a little bit of time talking about what's called the Pension Review Board's funding guidelines. And for those of you who are not familiar with it, the Pension Review Board is a state of Texas agency that oversees all public retirement systems in the state of Texas. They have established funding guidelines to provide guidance to defined benefit plans on how they should fund their plans. And they've established minimum standards for funding. And so I want to draw your attention to funding guideline number 4, because this is the most important related to what we're going to be talking about today. And number 4 says that actual contributions made to the plan should be sufficient to cover the normal cost and to amortize the unfunded actuarial accrued liability over as brief a period as possible, but not to exceed 30 years. I'm just going to pause right there because, as I mentioned earlier, we currently are at 33 years. So we are beyond that 30-year threshold. It goes on to set a preferable target of 10 to 25 years. It also says that benefit increases should not be adopted if all plan changes considered cause a material increase in the amortization period and the resulting amortization period exceeds 25 years. That is the single most important funding guideline to our discussion here today. These funding guidelines are the basis for what is called a statutory funding soundness restoration plan. So the Texas legislature has passed a law that requires any pension system and its plan sponsor to create a funding soundness restoration plan, called an FSRP for short, if the system is outside the Pension Review Board's funding guidelines for 3 consecutive years. So obviously at 33 years, we are beyond 30. So we are in our first of 3 years. So we are on the at-risk list. There are currently 7 other retirement systems on the at-risk list, meaning they haven't got to their 3rd year yet, but they have triggered at least 1 or not 2 of those years. And the reality is our current trajectory is that we will trigger this requirement. And this is a statutory requirement. This is set in law. So that really brings to why we're going to need legislation. If we do nothing for the next 2 years, we are going to be outside the PRB's funding guidelines for 3 consecutive years and trigger this law. And on the next slide, wanted to note the market returns. We're having a significantly down year in financial markets across the world. Those losses will absolutely trigger us moving farther, not closer to that 30-year in the next valuation. So absent any change, we are going to trigger the funding soundness restoration plan. And because COAERS is governed by state law, our governing statute is in state law. To change it, we need to go to the legislature. So what this means is whether we act now at the upcoming session or we wait, we will be forced to work with the city to develop a plan to get the system within the PRB's guidelines. And the requirements of the funding soundness restoration plan are a lot more onerous than if you get ahead of that and solve it yourselves locally. And now I'm going to talk a little bit about the philosophy behind the legislative proposal before I get into the nuts and bolts. So we've been working with the city for basically the last 2 years and very diligently over the last 12 months. My team and Ed's team have been meeting pretty much every couple weeks for almost the last year. And we have partnered to come to an agreed upon legislative proposal. And that proposal builds upon key industry leading practices and ideas that have passed the legislature in prior pension bills. Those include actuarially determined contributions. COAERS is currently funded via a fixed rate contribution. What that means is that we get the same percentage of payroll every year from the plan sponsor, the city, and from the membership. So there's no ability for those contributions to adapt to increase if we need more money. And that is not an industry-leading practice. They're also premised on the idea of shared sacrifice. This is something the legislature has stressed over and over again when many of our peers have gone before them, that they want to see both the plan sponsor and the plan members step up and sacrifice something to preserve the defined benefit. Additionally, risk sharing. This is an industry best practice and something the legislature has stressed. Inherent in any defined benefit plan are risks. And what they want to see is that both the plan sponsor and the employees share in managing those risks. And then lastly, the proposal, it was crafted with the PRB funding guidelines in mind, because if it doesn't meet the guidelines and get the system within that, it's not going to be approved by the legislature. So with that in mind, let me go ahead and speak specifically to the 3 key areas of the proposal. It deals with contribution policy, benefit policy, and governance policy. And I'm going to go into detail on each of these. I'm going to start with contribution policy. So within the contribution policy proposal, there's a component for the employer contribution. These are the contributions from the city of Austin. The city has agreed to transition to a flexible, actuarially determined employer contribution rate, which can increase if necessary to keep the plan on a steady path to full funding. This is a significant commitment by the city, and I applaud them for taking this step. Even more so, the city has agreed to pay off the unfunded actuarial accrued liability, which will in the future be known as the legacy liability, within a 30-year period. I cannot stress how significant of a financial commitment this is from the city. And I applaud them in their willingness to step forward and do this. This is a huge commitment from them. Also contained in the proposal is the ability for the city, if they are in a position to shorten that amortization period, which is currently going to be 30 years and closed, if they're in a position in the future to pay it down faster, they can. So that is kind of philosophically what's going to happen. And ultimately, this slide will talk about what are the 3 components of the city's contribution going forward. They will have a legacy liability payment for the next 30 years once this is enacted. And again, as I mentioned, this is a significant financial contribution. Their total contribution to the system will also include a normal cost payment. Normal cost is the cost of plan benefits accrued in the current year. And the calculation for that will be the city will pay the net from the total system normal cost minus the employee's contribution rate. So they will pay that portion. And then as part of the ADEC, the actuarially determined employer contribution, they will pay up to an additional 5% for future losses. That can go down if we have gains, but I'm going to focus on the loss side because that's the most important component of it. So again, they've stepped up and said the first 5% of this new ADEC we will take on top of paying down the unfunded liability. So that's what the city's contribution rate will be composed of. Now moving on to the employee contribution. And I know we've gotten a lot of comments through our website, and we really appreciate those. We want to encourage our members to continue to submit their comments. The Board of Trustees reviews all of these. We're going to be increasing the employee contribution by 2% from 8 to 10%. And a lot of the comments noted that at a time like this, it's very difficult. The city just did a 4% increase. That 2% would be a big bite to their bottom line and their paycheck. We've worked with the city's team and agreed to a phase-in of that 2% increase. So there'll be a 2-year phase-in. So beginning on January 1, 2024, the employee rate would go from 8 to 9%. And then on January 1, 2025, it would go from 9 to 10%. So we're doing the best we can to try to mitigate the impact on the employee's paycheck. But at the same time, back to the theme of shared sacrifice, we need to have the membership needs to kick in a bit to make sure we can get this through the legislature, especially given the city's commitment. But we did hear your comments and we did work through that. Now on to the idea of risk sharing. The city has taken on the first 5% of the actuarially determined contribution. So if there are losses, the city will continue to increase its contribution to cover that up to a 5% of pay number. Once that's in place, and if we ever max that out and we need more money, that risk sharing will kick in, and then the employees would have to kick in up to another 2%. Now, we hope we don't get to that, but we need to have that in there as a form of risk sharing. Again, this is an industry best practice and something the legislature is going to look for. Then if that is eventually breached, there is a provision that COAERS in the city of Austin would further develop modifications if the problems persist. So that covers the contribution component. I'm now going to talk a bit about the benefit proposals. And as I get into that, I want to note, first and foremost, there are no proposed changes to the final average salary, the multiplier, or calculation of accrued time. The basic formula for Group A and Group B are intact and are not part of this proposal. What we have focused on are benefit purchase options. And the philosophy that this working group went into was, first and foremost, we need to try to keep the system's finances held harmless. We can't take losses, particularly given the fact that we're adding a risk-sharing component through the ADEC, that we want to minimize future losses to the system. But we also wanted to preserve the option for the members. And so that was the philosophy going in. So there will be changes to the way that military, supplemental, and non-contributory service purchases are made, but those are still available to the membership. And I'll go into detail on these a little bit more in the next couple of slides. Sick leave conversion. What is going to happen there, and I'll talk a little bit more about it, the member will keep paying their contribution rate. The city is going to pick up the actuarial difference. And then on prior service buyback, if someone leaves, takes their money out, and wants to reinstate service, they can do that, but the interest rate will be the assumed rate of return during that time. So all of these would be set to go in on January 1 of 2024. So there will be time after the legislation passes for members to understand. We'll continue to educate on this, but these would be set at that point. So I want to go a little bit farther into a couple of these, like the military service purchase option. We've gotten a lot of comments about this. And so I thought it might be helpful to first explain how it currently works. Current policy allows for the purchase of this service where the member pays only 25% of the calculated cost. What that means is if someone comes in to buy that time and we calculate it to cost $100,000, they only pay $25,000 and the system eats the other $75,000. So that's essentially a loss to the system. those compound over time. And as we talked about the risk-sharing nature going forward, we're trying to mitigate those future losses to try not to trigger a future increase in the employee's contribution rate. But we also want to preserve the ability for this purchase to happen. So the proposed policy will still allow the purchase of up to 5 years. 5 years is significantly more than a lot of our peers offer. A lot of them don't offer this purchase or cap it at 2 or 3. So we're going to continue to allow up to 5 years. But the proposed policy would require that to be bought at the time of retirement and to pay the full cost. And this is equitable to all the other changes that we're making to service purchases. Speaking of the supplemental service purchase as well, employees on the next slide, the employees will still be allowed to buy up to 5 years. There will be no change to how that is calculated for Group A and Group B retirement purposes. The only change is that, like the other purchases, they will be made at the time of retirement, and it'll be the full actuarial cost. Again, going back to the philosophy of trying to keep the system from taking losses, but also keeping the option on the table for the membership. Sick leave conversion, that's another area where we've gotten a lot of comments and questions, and so I wanted to make sure I walk through exactly what's going to happen. The proposed policy does not change how City of Austin employees purchase their sick leave or transition their sick leave at retirement. The membership will continue to just pay their contribution rate for whatever time they're going to buy. The city will pay the actuarial difference on that, and that'll be included in the city's normal cost calculation. So as members, there will be no difference when you get ready to retire. If you have a sick leave balance, you will be asked to contribute what your contribution rate would be for those hours. The city will pick up that actuarial difference, so the system is held harmless. Because this impacts the entire workforce, this felt like an equitable way to make sure that that was preserved for everybody. So those are, in a nutshell, all the major changes that are going on with the benefit proposals. The last area is governance. So on governance, one of the proposals is to continue to increase the balanced representation on the board by converting an active member seat to a city-appointed position. Additionally, we're going to establish a risk-sharing valuation study process. This proposal contains a lot of nuance to it, where the gains and losses are, the city needs to understand what they may owe. We need to understand if there's anything that impacts the members. So the actuary is going to engage in this process. We're going to work collaboratively with the city through things like our assumption setting and the experience studies to make sure we're on the same page because of the proposal. Additionally, we're going to have in the proposal a requirement that city-appointed positions, or excuse me, citizen-appointed positions have certain pension expertise, such as governmental finance, pension law background, actuarial background, or securities investment background. And the last governance proposal on the next slide is that we're going to codify the process currently for a COLA before seeking legislative approval. So that process, as it is right now, is that the COAERS actuary needs to certify in writing that a payment, whether it's a COLA or a 13th check, is consistent with sound actuarial principles. It would then have to be approved by the board, and then lastly by the city council. It's very similar to what we're doing right now in terms of process, but we're going to make sure that that is codified. So that is the major points of the legislative proposal. And hopefully this has been helpful in digging into. If I have not mentioned something that you've heard, it is not included. I've definitely gotten some phone calls for folks. If you didn't hear me mention it, that's not something that we are including in our proposal. So now I want to take a moment to show you a comparative chart that walks through the current policy versus the proposed policy. This is a actuarial analysis that we just completed. And what it does is it models that if we were down 20% this year, and I hate to admit it, that could happen. And if we hit every assumption going forward, the blue line is the current policy. The green line is the proposal. And what you see here is that for the first couple years until the legislation is enacted, the funded ratio stays the same. But because the proposal includes corrective measures, you see that that funded ratio begins to flatten and then increase. And it continues to increase over time. Whereas the current policy basically flatlines, because we would be dependent under the current policy to get some form of gains to get ourselves headed back upwards. And those are things we can't count on. In the end, 20 years from now, there is a 28% difference in the funded ratio of the system. This is significant. I hopefully shows you in a visual representation that this proposal actually contains important corrective measures that will allow the system to get back on the right track if we have a down year or actuarial losses. Because under the current policy, we're dependent on things outside of our control to try to get our funded ratio improved. The next slide does the same kind of comparison, but with the unfunded actuarial accrued liability. And again, you can see until the legislation is enacted, the two lines are the same. But because the proposed policy has corrective measures built in that fix the system's cash flows and contributions, that suddenly begins to go down. And after 20 years, you have a $2.7 billion difference between what we would have under the current policy versus the proposed policy. And I think this is why a year like this is so important, that we have this type of proposal in place, because absent it, there is no corrective measure for the system to reset and start improving its financial health. So in summary, I just want to wrap up here saying, obviously the long-term funding is and is going to remain outside the Pension Review Board's funding guidelines. We've been working in partnership with the city. We have an agreed upon legislative proposal to strengthen the system. This includes changes to contribution, benefit, and governance policy. And that actuarial analysis shows that the proposal significantly improves the financial health of the retirement system over the current policy. The goal here, as I get to my last slide, the COAERS board is singularly focused on strengthening and preserving the defined benefit plan. And we're very fortunate to have a partner in the city of Austin who shares that same goal. And we've been working together with that in mind. Now, retirement benefits are not at risk in the short term. So retirees, your checks are going to keep coming in. But we have a responsibility to all generations of COAERS members, including those who are going to start working for the city in 20 years. And we'd much rather be in a position when they start that the system is funded in the high 80% than just in the high 50%. And so preserving this defined benefit for all generations is our focus and what's driven the work here with the city. And again, we're so lucky to have a partner with the city that shares that same vision. So that concludes my remarks. I'm going to turn it over to Mr. Ed Vanino, the city's Chief Financial Officer, to speak from the city's perspective.
Thank you, Chris, and welcome everybody. Thank you for having me here today. Just want to commend Chris and his staff. I think they've been doing a fantastic job with this, with these reforms we're trying to pass. Fantastic job in terms of getting the word out, informing our members. This is the second town hall meeting environment like this we've had, streaming them virtually so people can watch online as well. They're recorded so people that weren't able to attend today, providing a venue to ask your questions and getting quick responses out. And I think importantly to just nip inaccuracies and rumors in the bud, because there are a lot of concerns that are going on out there, and most of them are not accurate. So it's important that we have Chris and his team to make sure that accurate information is getting out. I just want to make sure that everybody hears that the city of Austin, our city management, our city council are 100% committed to the sustainability of this system. For our retirees who are former city employees and who are relying on this system, on the pension system as a large part or maybe the sole source of your retirement income, ensuring that income stream is there for you in perpetuity, like it was promised, is absolutely essential to our organization, and we're 100% committed to it. For those of you who are maybe decades away from retiring, we're 100% committed that when you retire, these benefits you're being promised will be there to you. You can see that commitment not just in the legislative changes that are being proposed and the extent that that increases the financial exposure for the city, but just in the actions that the city's already taken in partnership with COAERS to ensure the sustainability of the system. The city currently contributes 19% of active member salaries to the system. Under state law, it's only required to contribute 8%. So the city is currently contributing more than double every single year to the retirement system to keep the system is in the financial condition that it's in than it's required to. In fact, it's 137% more than what we're required to contribute. The city has been contributing, and that's been going on for more than a decade at different levels. But currently, we're at that 19% level. Getting these reforms enacted is not only really important to us as a city organization so that we can live up to the promises that we've made to all of our retirees and our active members, but it's important to us in regards to our own financial outlook and our financial rating. The city is a big organization. We issue a lot of bonds every year. We need to build roads. We need to build fire stations. We need to build libraries, parks, recreation centers. And the amount of money we have to pay in interest on those bonds is dependent upon what's known as a rating, as our credit rating. There's 3 major rating agencies, Moody's, Fitch, and S&P, and 2 of those rating agencies in the last 2 years have downgraded the city's credit because of mounting unfunded pension liabilities. You saw the number Chris put up there. Our police system also has some unfunded liabilities, as does our fire department. The rating agencies look at it collectively and said the level of unfunded liability on our pension systems is more than is warranted for a AAA rating agency. So we've been downgraded to AA+. That means our interest borrowing costs are a little bit higher than they otherwise would be. And so that's just a really important consideration for the city in that regard as well. I do just want to provide one example. We went through a very similar process with the Austin Police Retirement System in the 87th legislature. This upcoming legislature will be the 88th. And in the 87th legislature, we were able to implement a broad package of reforms to the police retirement system, almost identical to what Chris just laid out. A much lower benefit tier for new police hires. You didn't see that in this presentation, but COAERS already has a Group A and Group B benefit tier. Back in 2012, COAERS already implemented a lower benefit tier, but with APRS, lower benefit tier. The city is contributing significantly more money to the system. The members also increased their contributions by 2%. The members went from 13% of pay to 15% of pay. And with just those reforms in a single year and a single valuation, the system went from having an infinite amortization period, which doesn't sound good. And trust me, it's not good. Essentially, they were never going to pay off their unfunded liability. They were targeted to run out of money at some point in time. They went from an infinite funding period to 30 years. Now you're seeing some of the financial problems that all the institutional investors and private investors and individual investors are all having struggles right this year in the market. It's not been a good market year, but in APRS we have this flexible funding model in place. And so when APRS, if they see a significant loss this year, the city contributions will automatically adjust to keep them at that 30-year or less funding period. And so we don't have that in place with COAERS yet. We're going to get that done in the 88th session so that in the future, as there's those inevitable ups and downs in the market, the system will self-correct and ensure that we stay within the parameters of a healthy system. So I'm really excited about this. I was a 10-year board member up until a year or two ago. I stepped off the board. Really active in the police retirement reforms. Been very, very closely working with Chris and his team on the same reform for COAERS. I think we have an outstanding opportunity in this next session. Very strong likelihood that we'll get these through the legislature and get the system back on the right track. So I'm happy to answer any questions you have. Again, thank you for having me here today.
Thank you, Ed. And I think at this point, we were going to turn it over to folks in the audience. If you have any questions, Michelle Mahoney is there with a microphone, just so that sound is broadcast to our folks who may be dialed in or watching online. So If anybody has any questions, please feel free to raise your hand and Michelle will bring a microphone over to you.
Yes, thank you all. Throughout your presentation, it struck me that you expressed a lot of confidence, and particularly your final comments of the legislation that been successful. I would just like to ask if you might comment on why you feel that there's just a strong likelihood. I was just wondering, before you even said that, what might the risk be that we didn't get it done? But you sound really confident, and I would just like to ask if you might just comment a bit about why you're very confident that we'll be okay.
I think, and I'll let Chris comment too. I'm sure he has things to say, but I think we're on the same page on this. We're confident because the package of reforms is tried, tested, and true. The legislature has approved these same package of reforms just last session for the Austin Police Retirement Association. They've approved similar types of reforms in Houston and Dallas and other cities. The Pension Review Board is a state-appointed board that provides oversight to pension systems, and they put out guidelines in regards to pension reforms and sustainability matters. And everything we're doing is 100% consistent with what the Pension Review Board is recommending, and they have a lot of influence on pension matters up at the state legislature. So I think for all of those factors, we're not doing anything new or different or wacky. We're just doing what is good common sense, best practices that have been implemented in other systems and applying them to COAERS. So I don't know if you could add anything.
Yeah, I think the one additional comment I would make is that we have a agreed upon solution between the plan sponsor and the plan. That is critical in the process, that we go up partnered hand in hand with the same message. There's a lot of times where a issue for a system needs to be addressed and the plan sponsor wants one thing and the pension board wants something else, and then the legislature has to mediate that. I've seen that time and time again. I was the executive director at the Pension Review Board for many years before I came over to COAERS, was involved in a lot of those events. The legislature was clear: solve your problem, agree to it locally before you come up. And we've done that. So to build on top of that, I think the fact that we have an agreed upon proposal significantly improves our chances. You never know at the Texas legislature, the way it's designed is not, it's easier to kill a bill than to pass one. And we've also been keeping everybody informed. I think we're doing it the right way. Having these events for our members, I mean, these are going to be questions that we get that they're going to want to make sure that we've done it the right way. So there's no guarantees in life, but I think we have a significantly better chance than a lot of our peers did because we've checked all these boxes. We've worked together in a partnership. And to Ed's point, these are measures that have been previously passed and by some of the more influential pension legislators at the Capitol. And so they're going to recognize that we're utilizing a similar model to something they've drafted, and that will help our chances as well. Yes, ma'am.
I think the third factor is the timing of going now, not waiting until it is in a critical, absolutely no period, running out of money situation. And I think that's something that multiple legislatures have been very, very, they've communicated that many times. Don't wait until the house is on fire. They want to see these things addressed early. The partnership helps, but also being able to show that we're coming at it now, allowing a phase-in period for our employees, not coming back and saying we have to quickly fix all of this right now and you're all going to have to jump up a huge percentage. Addressing it now shows that pre-planning, and that's the type of fiscal responsibility that I think all of our legislators have made clear that they're looking for.
Thank you for the presentation, the in-depth information, very much appreciated. Following up on the legislative question, first one I think will be pretty straightforward, and I have a follow-up. I assume our local delegation have been informed on this matter and are being kept up to speed on where the city and COAERS are on on the matter. Is that an accurate statement?
Yeah, our governmental relations teams have been in meeting with them. We've just gotten the kind of the package over to Texas Ledge Council. So we're still working through that, but they are aware of it. Once we get the final product, and obviously they're really focused on the elections right now. So we're being mindful of that. Once we get through that part, we'll be working very diligently with their offices on all these details, but they know this is coming. We've been communicating with them and as well, occasionally with some of the leadership over there. And again, the message is very similar to what we just said is you guys need to make sure all these boxes are checked. But yes, we're working with those offices.
Great, thank you. The second question I had was digging in a little bit about the supplemental non-contributing service purchase request. I'm not entirely sure I understand the mechanics of it, so I wanted to follow up on that. Currently, let's just say that one wants to purchase service credit, you can buy up to 5 years after you reach your 5-year of being vested. And those years count towards meeting your 23 years or 30 years of eligibility. With this only being allowed at retirement, this is where my question is does one have to reach 23 years of service time and then purchase up to 5 more? Or if you are below that, can you still purchase to meet your 23? Thank you.
Yeah, and thank you. That's an opportunity for me to clarify. No, you do not have to wait. So if the purchase would then qualify you, you can do it then. So I apologize. I should have been a little bit more specific there. But no, it does not change that. So if you're at 18 and able to buy your 5 to get there, you could do it then. You do not have to wait till you get to 23 to buy that. So I should have been a little bit clearer, but thank you for following up on that. It's a great question.
Hi, I'm a current retiree, but I have a child who is a current employee. And I don't want to be, I got mine, screw you. Is there a point at which if the system is looking better, say the economy gets better and the track dives, for the liabilities dive significantly, is there a plan to reduce some of the shared pain to current employees?
So for the current employees, so within the proposal is the ability, if things get really better, for the city and COAERS to kind of to look at these items, and if there's an agreed to reset, there is a caveat for that in the bill. We're predominantly focused on getting this fixed first, but there is some provisions that allow the city and the COAERS to sit down and say, we want to set a reset on the midpoint, or if the city advances the payment on the unfunded liability, that the board and the city can sit down and re-examine these items and see if there's a agreed to written change to the plan. So that's built into the legislation to allow for that to take place, with the hope that we will eventually get there. And if we get there sooner, we could sit down with the city and talk about that. But again, I think our focus is really getting this passed. We put some language in there for that, but we got to get this fixed first. But we were mindful that if at some point we, get ourselves in a much better position, then if we can agree, if the city and COAERS agree to a slightly different approach going forward, that could be permissible. Ed, did you have anything else you wanted to add?
Just a little managing expectations part. This, good market. We're not talking about like 2 or 3 years of good market performance and we're going to be ready to reset this. I mean, if you look at some of those graphs that Chris put up on the screen, they go out 30 years. This is a long horizon before we start talking about having the unfunded liability 100% refunded and, having everything back to that level. So it's a very long trajectory, but Chris is correct. Somewhere decades from now, when everything has worked out and everybody's looking back and thankful that people had the foresight, 20, 30 years ago, this is in the future looking back to get this thing right. Yeah, then there's going to be some future group of people who are going to have to look at how do we reset that. But I just wanted to manage that expectation. There's nothing on the horizon that any level of market superb performance is going to allow us to get out of this hole in a short period. This is a long-term path.
Are there any other questions that we could answer for folks? I want to thank everybody for their time. I want to thank Ed Van Eno for coming here, and we've been working together for a long time. Dr. Kelly Crook, our legislative committee chair. We want to thank our membership for listening in. I want to end by saying, if you have questions that come up later, please do not hesitate to reach out to the COAERS staff. We're here to answer any questions you may have. If you're thinking about a service purchase and not sure how this may impact you, please contact our office. If you hear something from a coworker and you're not sure, please reach out to clarify. We're here to help you understand what's going on. We're going to continue to receive your comments. We do have a web page on our website that has the details of the proposal. There is a place for people to submit comments. Those are presented to the board at every regularly scheduled meeting. They do review those and discuss those. And so please keep giving us your feedback. It's important. We want to make sure that you have the correct information, that we're open and transparent about what we're doing, that you feel you can reach out. And if there's anything we can do to help make sure you have the right information or make sure you have a question, we have answered it, we want to be there for you. So please don't hesitate, folks online. We're going to post this on our YouTube page. So if folks weren't able to watch in real time, this will be available. So just want to reiterate that we are here for the members. We look forward to continue working with the city because we still have to go through the session. There's a lot of work still ahead for us. And we will continue to keep our membership up to date as we move through the next several months into the session and then during the session as well. So thank you again for your time. We really appreciate it. And I hope everybody has a wonderful Friday afternoon. Thank you.